If you're new to multifamily investing, the biggest decision you're going to make isn't just what to invest in, it's who to invest with. Your investment sponsor is the one steering the ship, and asking the right questions can protect your capital and boost your returns. In this video, I'm breaking down 14 key questions every new investor should ask before writing a single check so you can invest with confidence, not confusion. Question number 1, how many multifamily deals have you successfully completed? So this is a great question because you've got some investment sponsors out there that just got started syndicating apartment buildings last year. Some of those sponsors aren't going to be able to survive the current economic headwinds that we're facing in the space today. You have other sponsors that maybe got started 7 to 10 years ago. It's those types of sponsors that I personally like investing with because they've gone through different market cycles in the past. We have a track record now of how they're able to operate with their head on a swivel. Question number 2, what's the total number of units that you have under management today? You're going to have some investment sponsors that maybe have a couple thousand units under management today. You've got other investment sponsors that have 10,000 plus units under management. Of course, it's not just all about the number of units under management, it's really how those units are being managed. If you're syndicating, a couple of different properties in a market with a couple hundred units, you're probably not going to have the in-place infrastructure, system, scalability, operations really effectively dialed in. Whereas if you're a multifamily operator that has thousands of doors currently under management in a market today, you have the ability from a size and a scale perspective to really put together the right systems, the processes, the procedures, the team really in order to be able to effectuate the business plan in that local market. Question number 3, can you walk me through current deal that has gone full cycle and what was the outcome? What were the actual returns from that investment? Because at the end of the day, it really does not come down to just trust, transparency. It's about the track record. So let's unpack the deals that maybe have gone full cycle, the deals that maybe have been home runs, the deals that you've acquired, renovated and sold that maybe were base hits. Question number 4, do you personally invest in your own deals? I oftentimes think that if the investment sponsor is not investing their own hard-earned cash into the deal, that it's a no-go for me. If they're willing to invest 5% or more into that deal or investment opportunity, now we have real alignment of interest. So I think it's incredibly important that investors understand, does the investment sponsor themselves have their own hard-earned cash invested into the investment opportunity, or are they just specifically or strictly raising capital from outside investors in order to be able to raise the equity that they need to acquire the asset? Question number 5, what markets do you focus on and why? An incredibly important question here to ask because it really isn't always just about the building itself or even the business plan. Oftentimes it comes down to the market that the property is located in and more specifically what submarket that property is located in. For example, I as an investor like to invest in B-class assets, in B-class neighborhoods. Why? Because I like safe, affordable neighborhoods. I like the workforce housing demographic, which is where the majority of the population in the US lives today. That is a tried and true investment strategy for me personally, because during times of economic expansion or during times of recession, you typically have investors either trading up into B class or maybe trading down into B class. And so for me personally, it all comes down to choosing the right market to invest in. Question number 6. What is your value add strategy and how do you implement it? Such a crucial question here. It's important for investors to really understand how is it that I as an investor am going to be able to achieve the 2x equity multiple that maybe the investment operator is presenting or projecting. Not every investment sponsor is going to be capable of executing a business plan. I like to invest with sponsors that have a proven track record, a rinse and repeat model where they can repeat the same business plan over and over and over again. That gives me personally a lot of confidence when deploying my own capital into an investment sponsor's deal. Question number 7, how do you stress test your underwriting assumptions? There's a number of different ways that investment sponsors can stress test the financials. They can perform sensitivity analyses on the financials. If you think about it from an underwriting perspective, there's a lot of different levers that the investment sponsor can pull from an assumptions perspective. So we can assume, for example, that cap rates might compress or expand. We can assume, for example, that we're going to be able to force NOI growth by renovating units and achieving a $100 or $150 rent bump per unit. These are a lot of different assumptions that go into the underwriting model. In addition to that fact, you've got assumptions relative to your CapEx dollars, your capital expenditures, right? How well dialed in is the investment sponsor on those CapEx dollar spend? And historically, have they underestimated those CapEx dollars? Have they overestimated what those CapEx dollar spend is going to look like? Question number 8. What fees do you charge and why? Some investment sponsors charge higher fees for a reason, because they're out hiring best-in-class talent, and best-in-class talent oftentimes comes with a higher payroll. So don't just necessarily drill in and dial in on what the types of fees are. Just make sure that those fees are in line with what the market is charging from an investment perspective. Question number 9. What happens if a deal goes south? How is it that you're going to be communicating with investors? The level of transparency from the operator during the course of executing the business plan or over the investment hold period is crucial. How transparent is that operator going to be with investors when there are headwinds, when they face challenges to the business plan? Are they going to be transparent with you during times that maybe occupancy starts to slip or concessions start to build? Really important that you have an operator that's not willing to shy away from headwinds that they're going to face during the course of the business plan, but rather they're going to lean into it and they're going to be willing to be transparent with you as an investor as to where that investment is at any point over the course of the investment hold period. Question number 10. How often will I receive updates and reports as to how the investment is performing? Again, it really comes down to that level of transparency and the frequency of communication. For example, I like investment sponsors that are going to provide me with monthly investor updates. So I have a look back period of where we started the previous month versus where we finished, what improvements maybe were made at the community level, where occupancy is sitting, not just from a physical occupancy perspective, but also an economic occupancy perspective. Does the operator have enough cash built up from a reserves perspective in order to be able to afford the unforeseen that might occur during the investment hold period as well? Question number 11. Who manages the property and is it vertically integrated? Such a powerful question here, because you either have an operator that chooses to use third-party property management, building construction, building maintenance, or you have operators that have everything in-house. I prefer to have an operator that can control the execution from acquisition all the way through disposition, and that the entire team is all in-house, full-time, W-2 employees on the sponsor's payroll. It gives me as an investor a lot of confidence, because what it does is it reduces execution risk, because the operator has the ability to act in the event that they need to change course. It's all an in-house operation that they can control the desired outcome and reduce that execution risk. Question number 12. What is your typical holds period and exit strategy? You may be locked into an investment for 10 years or longer. You may also be choosing an investment where the investment hold period is, say, 2 to 5 years, for example. It's important for you as an investor to understand that there may be times where it makes sense for the operator to sell the asset earlier, depending upon where we're at in the market cycle and how much of the business plan to that point has been completed. But secondarily, it might make sense to actually hold that investment asset for longer. The important thing here is that the investment sponsor is aligned to maximize profit for the investor. Question number 13. What are the biggest lessons that you've learned as an operator? Now, this one strikes home, and it really involves the sponsor being vulnerable enough to show you the potential warts, the lessons learned, the times that maybe they've fell down and gotten up from it. Really important to align with an investment sponsor that has undergone a number of different times in the past where they've had to pivot in their operations, where they've had to, instead of going in one direction, they choose to instead reinvent the business plan or the strategy and go in an entirely different direction. Question number 14, what makes you different from other multifamily operators? Not every investment sponsor, while focused on multifamily, is focused on the exact same type of a business plan. You might have sponsors that focus on more A-class luxury. You might have a sponsor that focuses on more C-class or workforce housing demographic, as an example. Certainly there's different market locations. They might have a different business plan. Their hold period might call for 2 to 5 years, or it might call for 7 to 10 years. So it's really important for you to understand that not all multifamily operators are all created equal. They have different teams, different business plans, a different structure in place, a different way to ultimately maximize and produce those returns for their investors. Thanks so much for joining us. Really appreciate you being here with us today. If you're looking for more information about investing in multifamily real estate, we'd love to hear from you, and you can connect with us at Rise48Equity.com.